In today's fast-paced economy, cheap debt has become a crucial tool for growth, especially in industries like oil. Low-interest loans allow oil companies to expand rapidly, build infrastructure, and invest in exploration and production. But as these companies grow larger and more powerful, questions arise about whether the benefits of this growth are really reaching the public. For many, the expansion of the oil industry driven by debt may be creating more harm than good. While the companies thrive, the environment suffers, workers face job insecurity, and communities are left to bear the brunt of the costs. Let's take a closer look at how debt-driven growth in the oil industry impacts various facets of society and whether this model is sustainable in the long run. Cheap debt has allowed oil companies to become some of the largest and most influential corporations in the world, with operations in countries across the globe. With access to billions of dollars in low-interest loans, they fund massive projects like offshore drilling, pipeline construction, and refinery expansions. This access to cheap capital helps oil companies meet global demand and solidify their dominance in the energy market. But there's a cost. While this debt-driven expansion boosts the oil industry's profits and market share, it often prioritizes rapid growth over stability and leaves the industry highly vulnerable during times of economic downturn. The bigger the debt, the greater the risk when markets change. This creates a cycle of boom and bust that affects workers, communities, and the global economy. The oil industry's reliance on cheap debt also leads to high-risk ventures in exploration and drilling. While deep-sea drilling and operations in politically unstable regions may generate significant short-term profits, they come with environmental risks and long-term financial commitments. The industry's focus on pursuing these high-risk ventures reinforces its dominance in the global market, but it also locks the industry into fossil fuel extraction, making it harder for alternative energy sources to gain traction. As these debt-driven projects continue to expand, the public feels the burden of this approach, with rising costs, environmental damage, and a slower shift to cleaner energy sources. As the oil industry expands, it often creates jobs in the short term. However, these jobs are not always secure. Many of the positions created during boom periods are temporary, and once the initial phase of construction or drilling is over, companies often cut costs to service their debt. This means layoffs, job instability, and a reliance on automation. The industry's push for higher efficiency through automation reduces long-term employment opportunities, leaving workers with fewer stable, full-time jobs. Instead of investing in workforce stability, companies often focus on maximizing profits and shareholder returns. This has led to a situation where the average worker is left with stagnant wages and limited job security, while the companies continue to benefit from debt-driven growth. While the oil industry profits, the communities affected by its operations often face negative consequences. Environmental hazards like air and water pollution are common in areas near oil extraction sites. These risks are rarely offset by the economic benefits provided by the industry. As companies continue to pursue profits, communities near oil operations are left with damaged ecosystems and poor health outcomes, while the financial rewards remain concentrated in the hands of corporate executives and shareholders. The public is left to deal with the environmental and social costs of a debt-fueled industry that prioritizes growth at the expense of community well-being. Moreover, the volatility of the oil industry, driven by debt, exposes workers and communities to further economic instability. Debt-driven growth creates an oversupply of oil, which can lead to price fluctuations. When prices fall, companies may struggle to pay off their debts, leading to layoffs, reduced production, and market instability. For workers, this means a lack of job security, as the industry is prone to cycles of expansion and contraction. For consumers, oil price volatility results in unpredictable fuel costs, impacting everything from transportation to food prices. This economic instability is a direct result of a debt-driven industry that prioritizes short-term profits over long-term sustainability. But the biggest question remains: is this debt-fueled expansion truly sustainable? While the oil industry's growth has certainly resulted in significant profits, the long-term consequences, environmental degradation, social inequality, and economic instability, cannot be ignored. The reliance on debt for growth has allowed companies to expand quickly, but it has also created a model that depends on constant growth and external financial support. The oil industry's emphasis on short-term profits, often at the expense of sustainability, has led to a system that is fragile and unsustainable. One alternative to this debt-driven approach is an ownership-based model, where growth is tied to real assets and profits rather than borrowed money. In an ownership-based system, companies would need to generate actual profits from their operations instead of relying on debt to fuel expansion. This would incentivize a more cautious and responsible approach to growth, with a focus on long-term stability and sustainability. An ownership-based model would encourage companies to prioritize sustainable practices and responsible resource management, as they would need to protect their assets to ensure long-term viability. This would reduce the environmental impact of oil extraction, as companies would no longer have the same incentive to deplete resources quickly in order to meet debt obligations. Additionally, an ownership-based model would promote greater workforce stability. Without the constant pressure of servicing debt, companies could invest in their workers, offering better wages, benefits, and job security. With less emphasis on cost-cutting measures and more focus on profitability through responsible growth, companies would be better able to invest in their employees and create more stable, long-term jobs. This shift could help mitigate the negative impact of automation and create more opportunities for workers in the industry. Perhaps most importantly, an ownership-based model would create a stronger incentive for companies to invest in renewable energy. Without the need to fund massive fossil fuel projects with borrowed money, companies would be able to divert resources to cleaner energy technologies and sustainable practices. This would accelerate the transition to renewable energy sources, reduce environmental damage, and contribute to a more sustainable energy future. The long-term benefits of this approach would be felt not just by oil companies, but by the global community, as the shift to renewable energy becomes more urgent in the fight against climate change. In conclusion, while the debt-driven growth of the oil industry has resulted in significant financial gains for companies, executives, and shareholders, the negative consequences for the environment, workers, and communities cannot be ignored. The reliance on debt to fuel rapid expansion has created an unstable system, where profits are concentrated at the top and the costs are borne by the public. Shifting to an ownership-based model, where growth is tied to real profits and assets, could create a more sustainable and responsible approach to energy production. By prioritizing long-term sustainability, worker stability, and renewable energy investment, an ownership-based model could help build a future where energy is produced in a way that benefits all, not just a select few. The question is, how can we push for this change and create a more equitable energy future?